Hello everyone, it's Brad from DividendReaper.com coming to you again with a weekly installment. And today, what I really want to talk about is a question that I get asked a lot by people my age. And that question is, how did you get started in investing? And quite honestly, the answer is, I just got too curious. When it really boiled down to it, a couple years ago, I think like 2.5 years ago, I started thinking more and more about how the numbers were going to add up, how we were going to retire. I started thinking about the fact that I really didn't want to work for the rest of my life, or at least I wanted to quit the job that I needed and start working the job that I wanted. Now, that's not to say that the job that I'm working currently isn't something that I'm happy in. It's just to say that there are definitely other jobs out there that I would rather do. If someone came up and said, hey, if money wasn't a factor, what would you be doing right now? And I digress. Let's go back to the topic at hand, which again is how I got started. But realistically, what happened was one day all those feelings really just boiled over. And I just started thinking, well, I don't want to pay someone to invest for me, because even if I were to do so, I would be constantly questioning myself about whether or not I could do better, and questioning if I really needed to pay that person to do it for me. So I started as most people did. I went ahead and just found a brokerage. TD was really, TD Ameritrade was one of the only ones that I knew about, other than E-Trade and Scottrade, and my parents were with the various ones, but I found a broker that I liked. I just quickly looked up as to which one costs the least to actually buy and sell on, because they'll give you just a firm rate as to what to go off of, if it was $7 per trade or $6 per trade. And I try to figure out which ones I could put a minimum in too, because I wanted to get started, but I also didn't want to throw a bunch of money at it and lose a bunch of money just as quickly as I got into it, because I knew that would discourage me, and I needed it for it to be a long haul kind of a thing. So I opened a brokerage account. After finding the one that had the lowest fees and didn't cost me any annual fees or etc., just like credit cards, you just try and figure out where you can save the most money and get the most bang for your buck. So I opened up my brokerage account and I immediately started making mistakes. I immediately saw how much money I could make off of penny stocks, and I threw a little bit of money at some penny stocks. And I quickly figured out, like most people who try to invest in penny stocks, that is not the way to get rich unless you are one of the very few, very lucky individuals that seem to be able to pick those like you're knowing a day ahead of time that you're going to win the lottery. And when I did this, I pretty much learned my lesson really quickly, that I wasn't going to be able to really make it off of this, and if I was going to continue to be what I felt to be an idiot about investing, then I needed to just get my skin out of the game. But I didn't want to get out of the game because I honestly just liked looking at the numbers. I didn't quite understand what the ratios meant. I didn't know what P/E was. I didn't know what EPS was. I didn't know what any of the ratios were. I just basically got a crash course knowledge of it, where I just looked at the companies and thought, oh, well, this is what it's been doing with its trend, and it'll probably go up, so I'll throw money at it. Very, very dumb way of investing. But that's how I did it at the start. And the good thing is that regardless of how the start ended up for me, it got my foot in the door, which then started making me more curious about how I could actually learn how to evaluate companies. And that's where I really started understanding, okay, I need to start understanding these formulas. I need to start understanding what EPS means. I need to understand how to read a financial statement. I need to figure out where those financial statements even are, because I didn't even know. I'd always hear people, oh yeah, I read their 1,000-page financial statements. And wait, what? Wait, I don't even know where that is. So I had to find out where it was. And slowly over time, I started really compounding knowledge about these things. And I noticed immediately for myself that really the pathway to getting rich was finding portfolios of people who had made it already and trying to see what they did. And one of the people that immediately came to mind for me was Warren Buffett, because we're in Nebraska and Warren Buffett is huge here, just like he is in the rest of the country, but it just hits closer to home. And for me, I started looking at Warren Buffett and I started looking at what he was invested in, and there was a common trend, which was dividend paying stocks. And I found that once I started learning the numbers, that a lot of the dividend payers were actually very, very firm companies that were very good with their money. They had low debt for the most part. They knew how to manage the business, and if it went down, it usually found a way to climb its way back up because they knew how to become profitable and how to stay up and current on those profits because they needed to pay dividend holders or shareholders pay the dividends. Now, from that point, I started solely investing in dividend stocks, which at this point now was a year and a half ago, 2 years, yeah, about a year and a half ago. And so I started choosing only dividend stocks and using a site called Dividend.com to basically see how long they had been paying dividends. Because my thought was if I invested in companies that had paid dividends for X amount of years, they probably would continue to pay those dividends because they'd make stockholders pretty angry if they decided one day to just stop issuing the dividends. And thankfully, this strategy really worked. And the more knowledge that I built up, I realized that I was almost mistakenly figuring out what a lot of the greats had figured out, which was that dividend investing is an incredible vehicle to produce greater wealth, mainly because I don't have to sell. So the biggest thing that really hit home for me was seeing people that I had known that went and retired, and they kept telling me how much they would be taking out of their savings. And I kept doing the math in my head going, well, if you're taking out $50,000 this year and you only have $800,000, is it being replaced? And the answer was no. On traditional portfolios, it really wasn't getting replaced, or at least it wasn't getting it replaced at the rate of which it needed to be. And if, God forbid, something like in 2008 and 9 happened where it crashes and you lose almost everything, well, your $50,000 you're taking out is going to be so much heavier than it normally would be. So the biggest thing that I realized was that investing their way may work for some, but for me it wasn't going to work because it would kill me inside to have to sell something to make money. So dividends were the perfect pathway for me because I realized I didn't have to sell. I could hold these companies that I love and grow with the company while being paid and using that income really to fuel the snowball. The other thing that I really realized at that point moving forward was that with a smaller portfolio, it was most important to throw my money at the big ticket dividend payers, but that I needed to also weigh out how big the dividend was to whether or not it would get cut. Every now and then I'd see a 10% dividend and I'd look into it, and the deeper and deeper I got into it, I realized, man, this is a garbage company that's just issuing dividends to try to entice people to come in, and as soon as they come in and the price goes up a little bit, they cut the dividend, which does nobody any good. So I had to really look at that balancing effect as to what companies I could get that had safe dividends to continue, but the highest rate that I could to really grow my snowball, because the more small dividend payments I got, the faster the wealth really started to accumulate. And this year especially, I think we're on track already to triple what we were going to make last year just off of it, just because it's just the compounding effect, which is constantly stressed by Warren Buffett, which is just compound, just don't lose. And over time, I'm learning more and more and more, and I'm trying to share more and more because people my age are so stuck in, well, I don't have a lot of money. Oh, well, I don't have enough money. I don't know how you do it, but you must. No, I don't make that much money. I'm just learning more and more that the secret to it is just learning how to save. And once you learn how to save, if you put $100 in, if you put $200 in, if you put $300 in, the effect just multiplies exponentially as it compounds through. Or even the months where I was only able to put a couple hundred towards it, or even at the very, very start where it was literally $100, $200 that was going in there, it really just builds up. But the big trick is just stop thinking about it being $100 and start thinking about what $100 can be 50 years from now. So the one thing, if I could sum it all up as far as the main question at hand, which was how did I get started, it was I got hungry for knowledge. I saw people were making money. I knew I needed to go ahead and get my skin in the game too, and I just was willing to basically fail, which is really the biggest thing you can take from it, which is if you're out of the market, you're not going to learn a lot about the market until you have the hard lessons of buying the penny stocks and seeing it crash, buying a company that has large dividends and then having it cut, learning how one ratio may definitively be more important than other ratios on a balance sheet, learning that if you took 20 extra minutes just to read the fundamentals of the financial statements that are released, you don't have to read the 1,000 pages. You just have to read the main 20, the fat. But little tiny lessons you obtain through the way really build you up to where you can be, and the compounding effect is just insane. So I know this is a little long-winded, and I may have gone off topic a few times, but this is just the best way that I can figure out how to verbalize my personal experience getting into the market, how I got into the market, and how I did it. And again, going back to what the real meat and fat of the matter is I just got hungry for knowledge, and I was willing to fail to make it happen. And it's paying off pretty good at this point. But I'd love to hear from you guys to tell me exactly what your experiences were. Tell me if you were the lucky person out there that somehow won off of penny stocks, so that way I can throw some hate your way, and not hate, but just more so jealousy. Tell me if you've learned these lessons. Tell me if you didn't learn these lessons. Tell me if you had the benefit of what I didn't have. Tell me who your mentor was. I never had a mentor, but tell me how you got started, because anything that all of you can provide to me to pass on will help out anyone who is yet to get off the couch and start working on their own portfolios. So comment in the comment section, like this video, share this video, help me help other people get their skin in the game to try to convince them that you can't win if you don't play, and it's okay to fail just like I did, because I feel like very few people out there don't fail before they really figure out how the game works. So anyways, I would love to hear from you. This is all I got for today. This has been Brad with DividendReaper.com. Like, comment, subscribe, or stop by the website and say hello. But until next time, check it out.